How do unrelated commodities show surprising correlations in commodity spreads? Imagine two commodities that seem completely different, like gold and wheat, suddenly moving in sync. It might seem strange, but there are real reasons behind these unexpected links. When traders look at spreads between commodities, they often notice these surprising correlations. Even if the commodities are not directly connected by their use or production, their prices can still move together because of broader economic factors. One big reason is the overall health of the economy. For example, when the economy is doing well, demand for many commodities rises, pushing prices higher across the board. Conversely, during a slowdown, prices tend to fall together. This means that even unrelated commodities can show similar price trends because they are both responding to the same economic signals. Currency fluctuations also play a role. When the US dollar gets stronger, many commodities priced in dollars tend to drop in value. This affects commodities like metals and agricultural products, causing their prices to decline simultaneously, even if they are unrelated by nature. So, a change in currency value can create a link between commodities that don't seem connected at first glance. Supply chain factors can also create these links. For example, energy prices like crude oil can influence transportation costs for agricultural commodities. If oil prices rise, shipping costs go up, which can lead to higher prices for wheat or corn, even though they are not directly related. This indirect connection can cause their spreads to move in tandem. Financial markets add another layer. Many traders and investment funds buy and sell multiple commodities at once to diversify their portfolios. Their trading strategies, such as rebalancing or hedging, can cause unrelated commodities to move together. When funds shift their investments, prices across different commodities can change in unison, creating these surprising correlations. Seasonal and cyclical patterns also matter. Some commodities have demand or production cycles that happen at the same time each year. For example, agricultural commodities might peak during harvest seasons, and energy demand might increase during winter. These cycles can temporarily link the price movements of unrelated commodities. Understanding these factors helps traders analyze spreads better. When they see unrelated commodities moving together, it's often because of these shared influences. Recognizing this can help in managing risk, as spreads between unrelated commodities might be less affected by overall market swings. It also offers opportunities for diversification, since spreads can be traded based on relative changes rather than absolute prices. By paying attention to economic trends, currency shifts, supply costs, and market behaviors, traders can spot when these surprising correlations happen. This knowledge allows them to make smarter decisions, whether they are hedging risks or looking for profitable spread trades. So, even commodities that seem worlds apart can sometimes dance to the same tune, driven by the bigger economic picture.